Namaskar. A warm welcome to all of you. Myself, CA Vivek Khurana, and today we will discuss on a very important topic, understanding of transfer pricing fundamentals. And for that, we have with us very dynamic, very respected, and very learned faculty, CA Pallavi Dinodia. Ma'am, a warm welcome to you. And thank you very much for giving us your valuable time. And I just want to share, even Gauravji shared with us, Pallavi ji has written a book on transfer pricing from Bharat Law House, and I think now it's their third edition. So ma'am, एक complimentary copy चाहिए होगी आपसे. Thank you. Now it's over to you. Thanks a lot.
Vivek ji, thank you very much for this very kind introduction. I will try to do justice to the topic given to me, which is understanding transfer pricing fundamentals. I wish that the viewers enjoy this session as much as I know that I will enjoy this session. So welcome to today's session, everyone. I am CA Pallavi Dinodia, trying to give you a brief about transfer pricing and its fundamentals. If anybody has any queries during the course of the presentation, please feel free to write it in the chat box, and Khurana ji will endeavor to go through the queries and raise them as and when appropriate. So what is transfer pricing? Transfer pricing is a price between two related entities in a cross-border transaction. Cross-border means that one company is in India and one company is outside India. So these transactions, the price at which they transact is called a transfer price. But sometimes, because the entities that are transacting may be related, they may be able to influence the price and may not transact at the price that unrelated parties in uncontrolled circumstances would. And therein comes the need of an arm's length price. So what is the arm's length price? The arm's length price is a price at which unrelated parties in uncontrolled conditions would transact. Why did transfer pricing come into our law? Transfer pricing came into our law because globally there was a shift, and globally countries started to realize that multinational groups with companies in various jurisdictions or with entities in various jurisdictions were able to manipulate the price between themselves so as to move profits from a high tax jurisdiction to a low tax jurisdiction or to a more tax friendly jurisdiction. And therefore, there were tax leakages, or there was an erosion of the tax base in a high tax jurisdiction. To plug these tax leakages, slowly different countries came up with transfer pricing regulations in each of their countries. What is the Indian TP regulation? The Indian TP regulation is housed in Chapter 10 of the Income Tax Act. It starts from Section 92 and goes all the way to Section 92F. The disputes emanating from transfer pricing go to either the dispute resolution panel or to the CIT appeal, usually to the dispute resolution panel, which is especially constituted for appeals arising out of TP regulations or of international transactions. Recently, the amendments have also brought in the requirements of master file and CBCR, which is one of the BEPS initiatives. The income tax rules are also very important to be read with the income tax regulations which are given under the Act, as the rules lay down how the various provisions of the Act are to be applied and give in a very detailed manner how to compute the arm's length price. So what is the computation? What is Section 92, or what is the computation of income from an international transaction having regard to arm's length price? Section 92 lays down the scheme which, or is the chargeability section of transfer pricing. It says that any income that arises from an international transaction shall be computed with regard to the arm's length price. There's an explanation added which says that it also takes into account any allowance for any expense or any interest. Subsection 2 further adds to it that any mutual agreement or arrangement or any allocation, apportionment, contribution to cost, which may not necessarily have an income element, but is also a transaction in relation to a benefit, service, or facility, is also to be taken into account, and the arm's length price is also to be determined. Subsequently, as we all know, specified domestic transactions were added to our law. There was a very famous case of GlaxoSmithKline in which the Supreme Court said that if the law wants to include domestic transactions in transfer pricing, it must make an amendment. So subsequent to that, there was an amendment by virtue of which subclause 2A was added for specified domestic transactions. And subclause 3 says when should transfer pricing or when should the computation of arm's length price not be applied. So it says wherever it has the effect of reducing the income or increasing the loss, there they will not apply the arm's length criteria. Section 92F gives us the definitions. These definitions are for chapter 10 and they define an accountant, what is arm's length price, enterprise, what is a PE. Now, interestingly, even though the PE definition is only in chapter 10, there is no other PE definition in the Act. So even for an international tax purpose, the PE definition has to be seen from 92F. Specified date, by when do the filings have to be done, what is a transaction, are all given in the definition section. Now 92A is the meaning of associate enterprise. So 92A says that where there is a direct or indirect participation in either management, control, or capital of one enterprise, or there is a direct or indirect participation of the same person in the management, control, and capital of both enterprises, then such enterprises will become associate enterprises or AEs. This is a very wide definition, if you will see, because management, control, and capital is not defined under 92A1, which means that if any enterprise has management, control, and capital in another enterprise, they will become AEs. This was very wide, and to limit the scope of subsection 1, subsequently subsection 2 was brought into the Act, and subsection 2 defines in a way what is those scenarios in which it can be said that there is participation in management, what are the scenarios for participation in control, and what are the scenarios for participation in capital. Small example on my slide, if you will see. A is the ultimate parent company. It has a subsidiary B, which has another subsidiary C. So C is a step down subsidiary of A. In this case, both A and B will become associate enterprises of C because both A and B have participation in the capital of C, B having participation of the capital of C directly, and A having participation in the capital of C indirectly. In another example, if I tweak this a little bit, let's say that A is a parent and has two subsidiaries B and D. They further have two subsidiaries C and E. In this scenario, you will see that C and E will also become associate enterprises of each other because they both are fellow subsidiaries. Ultimate parent is A. So therefore, all these entities amongst themselves will become A's. Now, how does subsection 2 limit the scope of subsection 1? So it says for participation in capital, it says that where 26% or more is the direct or indirect shareholding by an enterprise or by the same person, or where the loan is greater than 51% of the total assets, where guarantees given are greater than equal to 10% of the debt, or where 10% of the interest in this firm AOP or BOI is held by the same person either directly or through another person indirectly. What is management? How is control in management? So management says where they can appoint more than 50% of the directors, or when one or more executive director can be appointed by an enterprise, or either 50% directors or an executive director can be appointed by the same person in both the enterprises or in all the enterprises. The third is there's an activity based criteria which makes two enterprises or multiple enterprises associate enterprises. The first is 100% dependence on the use of intangibles for manufacturing process and businesses. Now here you'll notice that the language of the act is only for 100% intangibles for manufacturer processing or business. So where there is not 100% dependence on intangibles, or the intangibles are for a service sector, there this criteria is not fulfilled. So for example, if somebody has a real estate, let's say somebody has a building and they want to give the building and they want to do a association with a hotel company. So you will see that sometimes the same building is Radisson, sometimes the same building is Intercontinental, sometimes it becomes Holiday Inn. In such a case, the hotel business that the entity is doing, who owns the real estate, is not 100% dependent on the intangible or the brand of the hotel that it is using for the time being. And therefore, since it is not 100% dependent, it can be said that they are not. So for example, Sheraton and the entity doing the hotel business in India are not associate enterprises because the Indian entity is not 100% dependent on the Sheraton intangible. Same way, the second criteria of dependence is where there is a direct or indirect supply of greater than 90% of raw materials, which is influenced under the price and conditions of the other enterprise. The other criteria is where the sale is influenced by prices and conditions of the buyer or the customer in such a way that they become associated enterprises. The last criteria of control is more from a domestic purpose, mainly from a domestic purpose, which means that either by like the old 40A2B, where an individual can either directly control or through his relatives or jointly have control, or through his HUF or through the members of his HUF and his relatives have control. So 92A2 through these various criteria limits the scope of 92A1, which is very broad and says that it could be direct or indirect control through management and capital and control. So 92 we have seen, which lays down the chargeability of what is to be done under transfer pricing. 92A tells us who are these associated enterprises whose transactions have to be checked at arm's length price. The next section is of what is an international transaction. So an international transaction is a transaction, like we just understood, between two or more associate enterprise, either or both of whom are non-residents. Now, why does it say either or both of whom are non-residents? If two entities transacting outside India are transacting with each other, how does India have any jurisdiction over it? So here they are trying to even bring into those cases where you may have a situation like Vodafone, where there are two transacting entities outside India, but the substance of the transaction is in India. In those cases also, arm's length price will have to be seen because India has a right to tax those transactions. Now, what are those transactions or what can they be? So 92B subsection 1 lays down purchase and sale of tangible or intangible property, provision of services, lending or borrowing of money, any other transaction having a bearing on profit, incomes, losses, or assets, which could mean reimbursements or could mean any other transactions which don't fall into the pure criteria of purchase, sale, provision, or lending or borrowing. The last is includes a mutual arrangement or allocation for allocation or apportionment contribution incurred in connection with benefits facility to be provided or actually provided. Now, why is this last clause? The last clause is that usually a lot of multinational groups have a shared services center or have a management center or have a corporate office where they incur the cost for the group as a whole, and then that cost is allocated or apportioned across the world to various entities, and that cost that is apportioned is in lieu of a benefit or a service that that Indian entity or the entity receiving the allocation receives. So while the entity giving the service may not earn income, but it is still rendering a service and allocating its expense. Now these again were very broad. Subsequently, there was an explanation added to see what is purchase, sale of tangible and intangible property, what will be covered in it. This was done through Finance Act of 2012. Now, what is covered under tangible property? They have said that purchase, sale, and they have expanded the meaning to include transfer, lease, even use. Use of any property, article, product, or thing. So where you pay lease rental or you pay any type of rental for the use, there also this is covered under the definition of international transaction. It could include building, vehicles, machineries, anything that is tangible. What is intangible property? Again, purchase, sale, transfer, lease, use of intellectual property. And it includes transfer or ownership, use of rights, and other commercial rights. So it's a very wide definition of intangible property. And they have given an explanation also in the section to define what is intangible property. Then capital financing transactions, long-term, short-term borrowings, lendings, guarantees. There's a lot of litigation on whether corporate guarantees should be an international transaction or should not be an international transaction. So, but right now as our law stands, it is there in our law. It is there in the Form 3C EB that one is supposed to, as a CA, is supposed to certify. So while the controversy continues, whether guarantees international transaction or not, the compliance still has to be done. Same way for purchase and sale of securities. If you remember, there is a very famous Vodafone judgment which says that the transaction with relation to securities or shares is of capital nature and therefore is not income that falls within the definition of income as per section 92 read with section 2, and therefore is not subject to transfer pricing. Now in this case, there is a circular also by the CBDT that says that yes, we have accepted this decision and we are not appealing to the Supreme Court. Even though the judgment is there, the CBDT circular is there, again there is no amendment in the law and there is no amendment in the disclosure requirements under the 3C EB. So till such thing happens, my personal view is that these transactions of issuance of equity shares or transfer of equity shares must also be reported. Any advances, receivables, payments, any debt, deferred payments should also be reported. In this also there was a controversy on whether outstanding dues. So if you made a sale to an associated enterprise and you did not get the money within time, so maybe you had a credit period of 60 days or 90 days and you did not get the money in that 60 to 90 days, then it's an overdue receivable. The tax department treats this overdue receivable within this definition of capital financing and imputes the interest on it, which is then added to the income of the assessee in India and becomes a taxable transaction. So on that also there's a lot of case law available, there's a lot of controversy available, which is almost now settled to say that if the arm's length margin on the main transaction of sale is at arm's length, then nothing more needs to be imputed. Plus, if you have associate enterprises also that are paying you late, you have unrelated parties that are paying you late, then you must look at the parity between the two. Also, another version is that if you have a outstanding receivable, but you also have outstanding payable, and your outstanding payable is greater than your outstanding receivable, then you must net the two and then impute whether actually there is any income generation or any interest that can be imputed. So a lot of case law is available on this issue for those who are interested to read. Then what is provision of services? This can be any type of services: marketing, research, technical services, scientific services, legal, accounting, tax. It could be any kind of service that one associate enterprise gives to another. The other thing that they have added through the explanation is business restructuring. Now, if you will see, then 92B1 does not have business restructuring in its main definition or in its main text. But through the explanation, this business restructuring has also been added. And again, the controversy on this is that it could have been added because there is a clause for transactions having a bearing on profits, incomes, losses, or assets. But this particular item in the explanation says that even if there is a business restructuring and it has no impact on the business, on the profit, incomes, losses, or assets at that time or at a future date, it still has to be disclosed. And so accordingly, there is a amendment in the 3CEB, and now any business restructuring within the organization at the AE level, whether it affects the Indian enterprise or not, is required to be reported. Now 92B1 was told you what is the international transaction. The explanation gave you a detail of what is those international transaction. Now 92B2 tells you what is a deemed international transaction. So a deemed international transaction is one in which one enterprise has the ability to influence a third party with whom the other associate enterprise is having a transaction. This first was only from the scope of outside India. Now the scope has been increased to even include contracting parties resident in India. This is more easily explained through this chart. Now you'll see this is the scenario prior to the amendment, and I have compared it with the scenario post the amendment. Now prior to the amendment, you will see that F company, which is a foreign company, has the ability to influence the transaction with the third party where it has already agreed what are the terms of the services. An I company, which is in India, is transacting with this third party. Now in such a case, this becomes a deemed international transaction, because even though I company and the third party are not associated enterprises, therefore the transaction between them should not be international transaction. But because I company and F company are A's, and F company has the ability to influence the third party, the third party and I company become A's. Post amendment of 2014, the same scenario, even if the third party is within India, the same deeming provision will apply, and they will become deemed. It will become a deemed international transaction. The next is specified domestic transaction. So we've looked at chargeability under section 92. We've looked at who are associate enterprises under section 92A. We have looked at what is an international transaction under 92B. Now we are looking at what is a specified domestic transaction under 92BA. Here we are still just setting up the terrain in which arm's length price has to be computed. We are just still seeing who is covered, what are the transactions covered, who is the entity that's covered, before we actually get into determination of arm's length price. So what is a SDT? Like I said earlier, based on the GlaxoSmithKline case, the SDT came into our law. The first thing that the SDT got into our law was 40A2B. Now 40A2B was in our law from a long time. Now what was the need of 40A2B to be inserted into transfer pricing? So if you remember, 40A2B used to say that there is no expenditure that is excessive or unreasonable. But there was no yardstick to determine what is actually excessive or unreasonable. And to this effect, they linked this 40A2B with the transfer pricing regime and said that now the excessiveness or reasonableness has to be judged from the point of view of arm's length price. However, it caused a lot of compliance issues and a lot of other requirements even for small businesses, etc. There was a lot of discussion on how 48(2)(b) between domestic entities was tax neutral, and therefore is only causing compliance issues and should be not there in our law. And subsequently in 2017 this was omitted. What remains in our law today is transfer of goods and services under section 80IA 8, which is all eligible units generating, manufacturing electricity, or in backward areas, etc. So any eligible unit that has a profit link deduction that is available to it over there. Any transfer of goods or services between the eligible unit and the non-eligible unit is subject to transfer pricing. Any transaction with person covered under 80IA 10. Again, anybody who has eligible business which is transacting with a non-eligible business is covered. Any transaction under Chapter 6A or Section 10AA to which Section 80IA 8 or 80IA 10 applies. Again, people who have entities that have special exemptions like in Section 10AA, anywhere where there is a profit linked advantage that any entity is getting, in those cases it must be seen that whether the profit earned is at arm's length or not, and there is no transference of profit from a taxable entity to a eligible entity where the profit is exempt. Now the latest addition in this is through the Finance Act of 2020, which is for Section 115 BAB. Now if you remember, 115 BAB has newly been inserted for manufacturing companies with a lower rate of tax. Now this section says that anywhere where that manufacturing entity, due to its relationship amongst its entities with whom it's transacting, has earned more than ordinary profit, in those cases this transfer pricing shall apply. So this is the latest addition to the SDT regime, and we have to wait and watch what happens and how is this actually going to be applied. Now the entire SDT regime has a criteria of 20 crores. So in aggregate, if the SDTs are more than 20 crores, then transfer pricing applies. If it is less than 20 crores, transfer pricing does not apply. And this has to be seen not from a transaction to transaction basis, but for a aggregate amount of transactions. So now this sets up the what is to be done, who is to do it, and what is it to be applied on. Now the next thing is, how is it to be applied? How do we determine whether the transactions are at arm's length price or not, whether international transaction or a SDT transaction? How is it? So under 92C, the methods are prescribed. The first one is a comparable uncontrolled price method, then resale price method, then cost plus method, profit split method, transactional net margin method, or other method. Now these are the 6 methods that are given in our law, and they are generally termed as CUP, RPM, CPM, PSM, TNM. Now for those that usually do transfer pricing, these short forms are very easy to understand, but for a person who is getting into transfer pricing, they can sometimes be daunting. But the meaning is very easy. The application comes with time. So you'll see that in this chart that I've shown, the CUP, RPM, and CPM are price-based or transaction-based methods, which means that a transaction by transaction analysis can be done, or a price to price analysis can be done, whereas the TNM and the profit split method are profit based methods, in which only the profit comparison has to be done. And the other method is the latest addition to our law, which is also a price based method. Now, how does one determine the arm's length price? Are there any queries till now? Shall I continue?
One query. Yeah, one query is there.
हाँ जी.
Let me check. उन्होंने मोबाइल पे भी भेजा, यहाँ पे आई नहीं query completely. मैं आपको पे मोबाइल से भी भेज दूँ. This is by Shivangi Mittal.
Okay.
CA Shivangi Mittal. I am working as a consultant for Australian-based company, in which the Australian management does not have any direct control in the Indian entity. The management is also not the same. However, the Australian management are managing the Indian company indirectly, and the Indian company issues only one invoice per month to the Australian entity to carry on the exposure here. In this case, also transfer pricing applicable.
The question is whether transfer pricing is applicable.
Yes, yes.
Okay. So first we have to establish that whether these two entities are associate enterprises. So the first criteria is to first establish whether they are associate enterprises, in which we have to go back to the section that we had discussed to say that whether there is participation in control, capital or management. Now, like Shivangi said, that there is no direct control in terms
Yes.
of management, capital or control, and therefore under the criteria, the first criteria itself, there is no associate enterprise relationship that is established, even though they are working maybe 100% for the Australian entity. Now we go to subsection 2. In subsection 2, it says that only where you can fall in any of those criteria of subsection 2 can you become an associate enterprise. So if you have only a single customer and you are an independent organization which does not have any control or is not controlled through capital or management, then because you don't fall in the definition of associate enterprise, even though that may be your single customer, transfer pricing will not apply. Is that okay, Vivek ji?
Another query from CA Arpit.
Okay.
In case of SDT invoices, in case of SDT invokes for section 115 BAB, will the transaction value of 20 crores be considered? Also,
yes.
Also everywhere else, it will be transaction value based, but for section 115 BAB, it will be margin based. Is this assumption right?
No. So if you see the amended section of SDT in the Act itself, it says as given in subsection 4 of 115 BAB, and then after that it says that this is also subject to the aggregate value of 20 crores. So therefore, here also the aggregate value of 20 crores has to be seen for the transaction and not for the margin. The same issue arises even in the other case of 80IA8, where they say that more than whether a business earns more than ordinary profit. Even though the language relates to profit, but for the aggregation of transaction, you have to see the transaction of sale or purchase of goods that is actually being done between the two entities and not the profit.
Okay. Okay, please.
Okay. So carrying on. So what is the process for determination of arm's length price of an international transaction and of a SDT? So the first step is selection of the tested party. Tested party is, who is a tested party? Now this is not defined under our Act. Anytime there is a comparison, the comparison has to be of an entity versus another entity. So who is a tested party? The tested party is the party whose margin or whose price is being tested. And I'll explain it a little bit further again in the relevant slide. Once you've selected the tested party, the next thing to do is an analysis of the transfer pricing methods with respect to the facts of the taxpayer and the aid. So you have to understand what the taxpayer is doing, what its A's are doing, what we normally call as a FAR analysis, a function, asset and risk analysis, both with respect to the taxpayer and the A. Once we have done a FAR analysis, that helps us also determine who is the tested party. The third step is based on this analysis to see what is the most appropriate method out of the 6 methods that I explained to you in the earlier slide. And then once the most appropriate method has been determined, then is the application of that method to determine the arm's length price of either the international transaction or of the SDT. So selection of tested party. Who is a tested party? A tested party is a party to which a transfer pricing method can be applied in the most reliable manner and for which most reliable comparables can be used. It is also the tested party. Tested party is usually also the party which is the least complex one amongst the controlled taxpayers, which has least amount of unique intangibles or assets or the least amount of risk. Now, in selection of tested party, interestingly, the landmark case is a case of Ranbaxy, in which what Ranbaxy had done is that it said that the Indian entity has unique intangibles and the Indian entity actually is a manufacturing entity and manufactures the medicine. And the subsidiaries it has all over the world are all distributors. And therefore the distributors are doing a simple function of selling. And therefore the distributor is the simpler party, is the party that has less risk, is the party that has no valuable intangibles, and therefore it took all the sellers as one class of associate enterprises and assumed them to be the tested party, and the Indian entity was the AE. So they tested the margin of all the subsidiaries that were doing the selling activity. This was not accepted by the ITAT in Delhi, and they said no, the foreign parties cannot be taken as the tested party. Subsequently, Ranbaxy signed an APA with the Indian government. In the APA, the foreign parties as the tested party were accepted, and subsequently the ITAT also accepted the foreign party as the tested party. So as far as our law is concerned, as far as chapter 10 is concerned, there is no definition of tested party. And so what we have in terms of guidance for who is the tested party is available either in the guidance note by the institute or by OECD, which has laid down the criteria to be the party to whom the transfer pricing method can be determined in the most reliable manner, for which most reliable comparables can be used. So sometimes when we are doing transfer pricing and we are making transfer pricing studies, even though the Indian party may sometimes be the more complex party, but we may not have access to foreign databases, we may not have access to foreign comparables, and therefore we cannot judge in a reliable manner what would be the arm's length price if the foreign party was taken as the AE. And in those cases, by default, the Indian party is taken as the tested party. Sorry. And so therefore, sometimes it is the limitation of the database or the availability of comparables that makes us use the Indian party. And sometimes genuinely the Indian party is the more or the less complex party. It usually doesn't have intangibles. It's either giving basic services or it's importing critical raw material, doing basic manufacturing in India, or is a back office or doing some support R&D, etc. So Indian party is usually the tested party. But I've given some rulings in my slides, which you can refer to at some point if you would like to, read more about it. But now jurisprudence in India is slowly accepting the fact that the foreign AE can also be the tested party. So there's no hard and fast rule anymore of who is to be a tested party. The next is most appropriate method. Now, how do you determine what is the most appropriate method? Luckily for us, this is also defined in our rules. So Rule 10C tells us what is the most appropriate method. Our law does not give any hierarchy of methods. So it doesn't say that, you should apply CUP over TNM or you should apply TNM over CUP or any of the other methods. Basically, any method that is best suited to the facts and the circumstances of the transaction should be used as the most appropriate method, as long as it gives the most reliable measure of the arm's length price in relation to the controlled transaction. So here I've used the term controlled transaction. So international transaction or a SDT can also be called a controlled transaction. Now, what is the criteria of determining the most appropriate method? So Rule 10C2 again lays down various criteria. It says that we must look at the nature and the class of transaction. We must look at the FAR analysis, which is the functions, asset, and risk. We must look at the availability of data, the reliability of data. Suppose you have an unsigned quotation by somebody, is it reliable? Or versus you have a government regulation, that is a more reliable piece of data for judging comparability. And what is the actual degree of comparability between the controlled and uncontrolled transaction? Are you comparing apples and oranges, or are you comparing fruits and vegetables? What is the degree of comparability between what you're comparing and who you're comparing it to, or what you're comparing it with? So degree of comparability is a very important criteria for determining the method to be applied. The next is extent to which reliable adjustments or reliable and accurate adjustments can be made. So simple things like difference in contractual terms, like some is CIF, some is on an FOB basis, some has a credit period of 40 days, some have a discount, some have volume discount, some have, things like that. Can you make a reliable and accurate adjustment for it or not? If adjustment is possible, then maybe the comparable can be accepted. And nature and extent of reliability of assumptions required for the application of a method. Like for example, when you have to make an adjustment with regard to capacity utilization. Earlier, the statutory balance sheets used to have the full detail of what is the license capacity, what is the installed capacity, what is the actual utilized capacity. So you could get capacity utilization data from various annual reports. Now that requirement has been dispensed with by the accounting standards, so you don't need that in the notes to accounts anymore. So now if today you want to judge your particular entity with another entity and say, okay, I'm a startup and I've just started manufacturing and therefore my overheads are high and I'm not able to fully absorb my cost, therefore my profit is low. But another entity that manufactures the same product has a much higher profit because it is a better capacity utilization, or it is at better capacity utilization. And I would like to make an adjustment for comparison. That data is not available for that adjustment. And so you cannot make any reliable assumptions because you don't know. And in such a case, that comparable cannot be taken or that adjustment cannot be taken. So you also have to look at what is the reasonable assumption that can be made to apply a particular method. Now, every method requires you to judge comparability or establish comparability. Comparability has been defined under Rule 10b(2) of our income tax rules. It says that the first criteria for comparability is the specific character of the property transferred or the service. So for example, if I'm giving consultancy services in, let's say, accounting, and another person is giving consultancy services in the medical field, and I have to apply the comparable uncontrolled price method, and I say that, okay, a doctor is charging $100 an hour and the CA is charging $50 an hour, they are comparable. Are they really? No, because the nature of the service or the specific characteristic of the service is completely different, and therefore it cannot be compared. And CUP, when I come to CUP, you'll see that CUP requires strict comparability. So you cannot compare two services or properties transferred in CUP unless you can manage strict comparability. The second criteria is the FAR analysis, which is function, asset, and risk, which means that if the tested party is a manufacturer, I must find comparables that are also manufacturers. If the tested party has no assets or has a low asset base and is a trader, then I must compare it to traders with low asset bases. If the tested party it doesn't assume any risk and it is a low risk distributor or a no risk service provider, then I must compare it to somebody or some comparables that also have no risk, or if they have risk, I must be able to adjust for that risk to say that, if they did not have that risk, what would their margins be? Something as simple as if you invested in government treasury bonds, you have a low risk, so you have a low return. And if you invested in the stock market, you would have a higher return and therefore higher risk. I mean, doesn't apply right now in this current scenario, but usually in a normal market scenario, it would apply. So the next comparability criteria, contractual terms. This I've explained, like FOB, CIF, volume discounts, or any other benefit that you give in terms of, the contract that you enter between your entity and the AE and a third party. Another criteria is not last, but one of the main criteria is that also what is the market that you're operating in? Are you an export-oriented unit? Are you a domestic unit? What is the size of the market? Because let's say that you were in a monopoly market and you were a buyer, and the monopoly was of the seller. There, as a buyer, you would have to pay a much higher price. But if the situation was different and you were a buyer monopoly and there were a lot of sellers, in that case, the price would be much lower. So the type of market, whether it's a monopoly, oligopoly, also determines the comparability. Also, for example, whether you're an exporter or you're selling in the domestic market or you are an OE supplier. So there are companies that supply large volumes to OEs, which, have lower price versus other entities that supply in an aftermarket or supply to overseas and are exporters who get higher margins. So the market that an exporter will supply to, or the market that the exporter caters to, is completely different from the market that the Indian entity supplies to in an OE or in a domestic situation. And therefore the profit margins are completely different. In such a situation also, you cannot compare unless either you adjust or you don't use that comparable. Now it says government orders in force. So you know that when India is importing certain items or India allows you to export certain items, a floor price or a ceiling price is given by the government. In such cases where a floor price or ceiling price is given by the government, that price becomes the benchmark. You can't sell at a price higher than the ceiling price or lower than the floor price. And therefore those become the comparables. Cost of labor and capital. So similarly, a cost of an engineer in the US is not the same as the cost of an engineer in India. So how do you adjust for the two? I've explained level of economic development and competition. Again, wholesale and retail is also a very important factor for judging comparability. A wholesaler has a completely different profit margin and different cost structure than a retailer, and also does different functions. So when you look at comparability criteria, you can't just look at A. Once you look at A, then you'll have to look at B, you'll have to look at C, you'll have to look at D. The whole bouquet of comparability criteria will help you judge whether actually the comparable that you want to accept to judge the arm's length price or to determine the arm's length price is actually the correct comparable or not. So there's a lot of controversy on, a lot of case law now that is available on KPO versus BPO about low-end distributor versus high-end distributors, AMP services, where they say that distributors that take on advertisement and sales promotion are doing some more functions as compared to distributors who are not. So you can't compare the trading PLIs of the two. So there's a lot of jurisprudence now that is available on pure comparability and what is comparable. In the context of auto components, there is a case law available for core and non-core, for manufacturing entities who are manufacturing core products versus those who are manufacturing non-core products. The distinction is given in our safe harbor rules also, which say that core is basically like wheels, engine parts, suspension, transmission. So to my mind, anything that requires a car to move, or a bicycle or a motorcycle or a car to move, are all core products. So if the engine seizes, your car won't work, and therefore it's a core product. Versus, let's say that a headlight. If a headlight breaks, the car will still work. So a headlight is a non-core product. So same way, a core product manufacturer cannot be compared with a non-core product manufacturer because he is doing a more complex function, he's producing a more complex part, and therefore his risk and reward is higher. versus a non-core product manufacturer who may be using a more simplified process or technology and therefore, has a lower margin, or the market for a core product manufacturer, because it's so specialized, is maybe has 3 suppliers and therefore is able to demand a better price versus non-core, which may have many more suppliers. So all these criteria and factors are very important to judge comparability. Similar thing happens in the BPO or in the ITES space, where a person who is doing a higher end service of a KPO, earns more margin than a person doing a simple lower end BPO service. So comparability is to be established keeping in mind all the criteria laid down in 10b2, and then to see if any of these criteria can be adjusted. If not adjusted, then the comparable has to be rejected. Okay, so before I start on the methods, does anybody have any queries with regard to most appropriate method tested party?
Yeah, one query is there, Pallavi ji.
Ji.
From CA Nikhil Dhawan.
Okay.
Whether prices of stock and commodity index is valid comparable?
Whether? Sorry,
Prices,
I missed it.
whether prices on stock and commodity index is valid comparable?
Yes. Vivekji, I'll park this question for now. When I discuss other method, I'll discuss this more in detail. So the answer is yes, but I'll explain how once I do other method.
Okay, one query is there. Please also explain Rule 10 CA.
So to explain Rule 10 CA, we'll have to do one more webinar.
Chalo, we'll do that later on. One more
that
query.
Rule is so complicated on its own. It talks about a range concept, and in which method there is a range concept. So I'll do that. If a lot of people want to understand 10 CA, I'm happy to do it to another webinar.
Okay, and one more query is there from CA Ashwin.
Ji.
Indian subsidiary company transfers the shares of holding company to another Indian company, which is not related to the group company. Whether these types of transaction is to reported in form M3CEB.
Sir, so Indian subsidiary company can actually not transfer the shares of its holding company. The holding company will sell its shares to a third party in India, and the Indian entity actually has no role to play except for write in its register of shareholders who the new shareholder is. So a change in the shareholding, as far as, and I'm assuming that the subsidiary in India is the entity that whose 3CEB is being filed. So while the clause of the 3CEB that requires reporting of issuance of shares, this will not be covered. But where in the clause it talks about business restructuring, whether affecting the AE or not, my view would be that as abundant caution to still report it over there. While in my view, per se, transfer pricing should not apply, but still what is business restructuring and how it is to be applied, etc., is not very clearly defined. So sometimes it's better to err in the favor of caution and report something rather than not.
Sure.
So technically maybe it's not covered, but from a 3CEB perspective, maybe in the last clause of business restructuring, because it is restructuring, even though it's being sold to a third party, sometimes groups decide that they want to exit a particular business and they want to move it from, any of their one verticals to another vertical, or exit a business altogether. Better to report it in the business restructuring clause.
Sure, please.
Okay, thank you. So I'll move on to what are transfer pricing, what are these transfer pricing methods, and how they are to be applied. So the next maybe 100 odd slides are on 6 methods. What I've tried to cover is explain what the method is, give at least one example of how it is to be applied, even though the examples are very simple. If you get a copy of my book, or if you have practically applied transfer pricing, you'll know that in practicality, they are much more complex than the examples I've taken here. But in the interest of everybody, I've tried to explain it in a simple way because I don't want to complicate it, and then people will feel it's too difficult to understand. So I've tried to keep it simple. Having said that, if somebody wants to discuss a more complicated question, you can write to me and I'll endeavor to respond. So what are these methods? So we have 6 methods: CUP, RPM, CPM, PCM, PSM, TNM, and other method. Now, CUP and other method are price-based methods. So I'll cover these together, and I'll also try and when I come to other method, I think it will answer the last question that was raised. And resale price and cost plus method are gross profit based methods. Transaction net margin and profit split method are net margin based methods. So if you look at the methods, while this is the order in which they are given in the Act, and I've retained the same numbering, but in my slides that you will see, I have reshuffled this numbering to be able to explain the methods that are similar to each other together. So the first is the comparable uncontrolled price method. Simple method: what is the price at which the unrelated party has transacted at? So simply it says comparison between price charged for property or service in a controlled transaction with price charged for similar property or price in a comparable uncontrolled transaction. This is the simplest method to use, but the most difficult to apply because of lack of reliable data. Typically what happens is, what is the price you have sold your goods at or services at, but you don't know if somebody else has sold similar goods or services to a third party for a similar price or not. So therefore, due to lack of comparable data, this is the least or the most difficult method to apply. And adjustments also, some are subjective and some are mathematical. So mathematical adjustments can be very easily made, like CIF, FOB, credit period, etc. But quality, like in one of my seminars, somebody asked me that my company bought paint from China and bought paint from Italy, and the paint from China was half the price of paint of Italy, and we applied CUP method, and the TPO rejected it. So I had to explain that yes, because maybe the quality of the paint that was bought from China was much lower than the quality of the paint that was bought from Italy. And therefore, on a subjective qualitative criteria itself, the two paints could not have been compared. So in CUP method, the thing to be compared, the transaction to be compared must be exactly the same or absolutely similar. CUP wants strict comparability. If you are going to compare sale of basmati rice, it must be sale of basmati rice. Within basmati rice also, there can be many grades of basmati rice. It must be the same grade of basmati rice. So therefore, CUP requires absolutely strict comparability, and where adjustment can be made must be of only those things which can actually be adjusted and not qualitative criteria. So here I have said what the rule says. So how to apply different methods are given in our rules. Rule 10b, A starts with CUP, B starts with RPM, C starts with CPM. So if anybody wants a step-by-step analysis of how each method is to be applied, it's all given in our rules. I've reproduced it here for the sake of ease. It's available to you. You can read it at your time. OECD also says that CUP method is the most reliable method if you can locate comparable uncontrolled transactions. And it says two conditions need to be met. One, that the differences should not be such that they can affect the price in the materially affect the price in the open market, like in my paint example, or where they do, reasonably accurate adjustments should be able to be made. If adjustment cannot be made, then the comparable must be rejected. Now, what are those things that can be looked at for adjustment? Quality of the product, which we've just discussed, contractual terms, CIF, FOB, credit periods, level and place of market. Again, in comparability, I've discussed this, that either you are in a monopoly market, oligopoly market, whether you have purchasing power, whether you have buying power, what is it? How developed is your market? What is your geographical market? Can you adjust for it? If you're selling to somebody, there is a case law available in which there's a tested party selling towels to America versus selling towels in India. And they said, no, the geographical market is completely different and therefore you cannot compare it. Similarly, date of transaction. Date of transaction is important where you have cyclical industries, So for example, let's say that you were selling sugarcane for producing, or sugarcane, after the sugar has been extracted, you have the sugarcane left and you use it to create biogas. And let's say eligible unit purchase that sugarcane, leftover sugarcane to produce biogas. In that case, the time in the year when sugarcane is produced and the juice is pulled out, in that time of the year, a lot of ganna, like they say, is available. And so the price may be lower versus in a time period where it is not produced and it becomes a rare commodity. In those cases, the date of transaction must be closest to the date on which you are trying to compare to your actual international or SDT transaction, which is your control transaction. You cannot compare something which is not in the same time period. So our rules 10b4 allows us to compare within the same year, or now where there are profit-based analysis and somebody requested in 10CA, even for 2 years prior in some methods. It allows you that. But still, in CUP method, it still has to be closest to the date of transaction because you're doing a price to price comparison. Intangible property associated to it. Suppose you're doing a transaction which has an intangible associated to it. That intangible may have a completely different effect on your price, on your commodity versus on your goods versus somebody who does not have an intangible, and therefore they cannot be compared. The last is foreign currency risk. Who bears the foreign currency risk? Are you billing in dollar and therefore, bearing the foreign currency risk? Is somebody else billing in rupee and therefore not bearing any foreign currency risk? So it depends on each transaction and whether that risk can be adjusted for or not. So these are usually the type of risks that are there in CUP method. Now, what are the transactions that CUP method usually applies to? So it applies to sale, purchase, and transfer of tangible property, like raw material purchase, sale of finished goods. Now, usually here, one would also add sale, purchase, and transfer of intangible property. I've seen it in lots of places where CUP can be applied to intangible property. My personal view is that intangible property by definition is a unique property. So an intangible is something that is unique and therefore gets a intellectual property registration. And since only those intangibles can get registrations which are unique, therefore no one intangible should be able to be compared to another intangible. And therefore, due to its uniqueness, and because CUP requires strict comparability, you cannot say that a technology to make a computer that, let's say, Lenovo has versus Dell has is exactly the same. And therefore, they are both the same, and then therefore CUP can be applied. To my mind, in theory maybe, but to my mind, I don't agree with it. So provision and receipt of services, these are generic. Lending and borrowing, payment of interest on loans, reimbursement of expenses. In all these type of illustrative transactions, you can easily apply CUP if comparable data is available. Now, what are the types of CUPs? There are two types of CUPs that are available. There's an internal CUP and an external CUP. What is the difference? Now, an internal CUP is a CUP in which the same party transacts with two different entities. One is a AE and one is a third party. In such a case, you have an internal CUP that is available. What is the external CUP? External cup in theory, I mean, it's looking very good on the slide, but it's very difficult to get in actuality because, you know, XYZ who transacts with its AE for sale of goods, they have the price. But who will know how much, you know, B Limited transacts with D Limited? If you did have such a transaction and you did have such a value available, then yes, you could apply an external cup. This usually happens in cases where you have maybe an overseas AE who's transacting with a third party. In that case, maybe you'll, you know, be able to get a external cup. Examples on cup. So now this is a very easy example on cup that I've put here. You'll see related party C, which is in country C, has a 10-year contract for 2,200 metric tons of an alloy. The alloy mix has 0.5% gold and 1% silver. The port of shipment is Australia. The price per metric ton is 29,500 and it's on FOB basis. Now there's a supplier A in country A, which is uncontrolled. Also has a long-term contract of 8 years for 3,000 metric tons. The alloy mix is 1% gold, 1% silver. Port of shipment is Japan. Price per metric ton is 32,000. Other terms CIF. Similar criteria for supplier B in country B. So short-term contract, 9,000 metric tons. Alloy mix is not known. Port of shipment is Russia. Price per metric ton is 28,500 and on FOB. Now in this case, I have to compare my control transaction and I have to find a comparable, which is either supplier A or supplier B. Now in this case, I am only selling 2,200 metric tons, whereas supplier A is selling 3,000 and supplier B is selling 9,000. Clearly supplier B is selling a much higher volume than I am selling. Also, the tenure of contract is much shorter. And therefore, based on the comparability criteria that I explained, as per 10b2, supplier B should be rejected as a comparable because neither can I make an adjustment for the period, nor can I make a reliable adjustment for the volume. And therefore, supplier B, as per CUP, is not a comparable to the transaction that I will have with my related party. So supplier A becomes the comparable. Now in supplier A, I'll have to adjust for the alloy mix and I'll have to adjust for FOB and CIF terms. If I can make reasonably accurate adjustments for these two criteria, then I can compare the per metric ton price for my related party transaction vis-a-vis supplier A, and therefore CUP can be easily applied. This is the same thing that I've said in this slide. Now in another example, you'll see here that I've charged 45,000 rupees. Delivery terms are CIF, quantity is 100, freight and insurance cost is then 90 days credit. And to a third party, I'm giving at 40,000 FOB, same quantity of 100, no freight insurance, credit period, they have to pay me on dispatch. So here, I can adjust for delivery terms and I can adjust for credit period. Now here my third party price becomes 46,083 because I'm not giving third party benefit of delivery terms or of credit period, and my AE price becomes 45,000. Here, since I'm selling at a price lower than a third party price, I am not at arm's length price. So the comparison between the arm's length price and the actual price must be done after all adjustments are made. These are certain rulings on CUP which are there for those who are interested. You can pull out these rulings and go through them. They usually say when CUP was applied, how it was applied, what were the adjustments that were made, if any other method was applied by either the TPO or the SECI, how the tribunal decided that CUP was the better method. So anybody has any questions on CUP?
Yes, 2-3 queries are there.
Angie, please tell me.
One is from CA Suresh Chauhan. He just want to ask, Pepsi versus Coke is comparable?
In what context? So yes, Pepsi versus Coke are both generic drinks. Yes, they should be both comparable.
And one query from CA Lucky. You want to know,
Okay.
can we apply different method for different years for the same nature of transaction? Can you
Yes.
can you ask the question why we do apply the different methods?
Yes. So you can, there is no bar in our Income Tax Act or in the rules to apply a different method on the same nature of transaction in different years. Because as you know, in income tax, every year is a different year and res
Mhm.
judicata doesn't apply. So we can easily apply a different method in each year. And yes, the TPO is absolutely within his powers to ask you that why you have changed the method and ask you for a justification. So you should change a method when only when you have a very good justification of the change. Like for example, maybe you were always applying TNM and now you have cup data available, or you have started selling to a third party. So you have cup data available, and cup is the best method, and has the least amount of litigation if you can apply it correctly. So you switch to cup. That's a very good reason to, change the method. Or you were originally applying cup based on some quotations or based on a supplier you had or a third party you had, which you no longer have, and now you want to switch to TNM or CPM depending on your facts. You can easily do that.
Okay, another query from CA Harsh Pingania.
G.
What are the different sources of data-based external cup?
So different sources of database that you
Mhm.
can use for external cup don't actually become external cup. Uh, Cup requires it to be a transaction between two parties, an actual transaction. Whereas database may not actually have a transaction. It may be like an index, like the question asked earlier, like a commodity index is also a database, or a royalty stat index is also a database. So databases can be many. For TNM kind of transactions, RPM, CPM, TNM, there are obviously, there's ACE-TP, there is ProVes, there is Capital IQ. These are the databases that have all the annual reports of companies in which you can, extract the data for these methods. As far as CUP is concerned, you will have to have an actual transaction, so you don't really have a database for it. But under other method, which I'll go to now, you have lots of databases available, like you have tips database, you have custom export data, so it depends on what your transaction is. And, there is a database available for it.
Acha, another query from CA Suresh Chauhan. He
Ji.
just want to know how, as a beginner, we can learn a practical implementation of these methods.
There is no way of learning without doing. So the
That's
more
what
you do,
I want to say. Just join the Pallavi at their office.
no, that's the best way. The more you do, the more you will learn. I've been doing this for 18 years, and I'm still not the expert. I also face questions and queries which I don't know have answers to, or client problems that I have to think about. So the more you do, the more you learn.
Yes. Please carry on.
Gee, so then the sixth method is the other method, which came into our law subsequently. And this came in because of, just like the questions you have asked me, that the practical problem was that not always did you have an actual transaction to compare with cup. So you needed a transaction allowing you to use, or you needed a method allowing you to use a price that could have been charged. So that is other method. It is the price that would have or could have been charged. This is what allows you flexibility, which was missing in cup. OECD also permits this. It says that as long as you have the data to apply it and you can fulfill the arm's length criteria, we have no problem. Now, what are the things that can be used as, you can be used under the other method are these. So a valuation report. So like in his example of sale of shares, when there's a sale of shares, how do you say that this sale of shares is at arm's length price? You have a valuation report. Or Indian entity buys some machinery from its foreign AE. how can you say that this machinery was bought at arm's length price? You have a chartered engineer certificate or a chartered engineer's valuation report. So valuation reports tell you the price that could have been charged or would have been charged between unrelated parties in an uncontrolled scenario. So these valuation reports would form under other method. Quotations from third parties. You know, normally when multinationals want to buy something or sell something, they'll ask for quotations from 3 or 4 multiple sources. All these quotations will act as comparables for other method. LIBOR used for intercompany borrowing. This LIBOR is established, it's available on the web. You can go check it out. We have FEMA guidelines that say that if it's a term loan for 3 years, it must be LIBOR plus a certain number of basis points. If it's more than 5 years, LIBOR plus a certain number of basis points. All these government guidelines along with data available in public domain will become the price that would have been charged in the other method. Similarly, tender and bid documents, cost allocations and apportionments. If the key to allocate the cost or apportion the cost is the same across all entities, then that allocation key becomes a other method, because then that shows the price that would have been charged. Similarly, somebody had asked me that commodity exchanges and stock exchanges, are prices on that allowed? Yes, they are allowed. They should fall under other method and not CUP, because they are not actual transactions. They are transactions that could be transacted at those prices. Similarly, RBI, SIA, FIPB, DIP, all these government authorities have approved royalty rates, right? In the olden times before they were scrapped, it was 5% of domestic sales, 8% of export. These were royalty benchmarks or maximum ceilings of royalties that Indian entities could pay. So these can be used as benchmarks. There's a SEBI guideline now that, you know, lays down the rules for royalty payment to group companies. Those can be used. So anything that is available in public domain that sets a benchmark or gives you a price that could have been charged or would have been charged in an uncontrolled scenario can be used under other method. The difference is in CUP, it has to be an actual transaction, and in other method, it could be a transaction that could have taken place at a particular price. So I have an example here. For example, that an AE took a place on rent from another AE for a monthly rental of 50,000, and the rate per square feet became 25 rupees a square feet, and it was required to prove what is the arm's length in this case. In this case, if it went to Magic Breaks or to Makan.com and it found similar, you know, prices for similar areas, it's showing 33 rupees per square feet or 36 rupees per square feet. And since the price of the AE is less than the price here, because this is in a domestic scenario, which is on the cost side. So if the price paid is lower than the price that would have been paid, the transaction is at arm's length price. Again, there are rulings available on other methods. These were originally on CUP, which allowed the use of, you know, publications, etc. And then subsequently other method came into our law. So 2016 we have Cargill, Gulf, and now we have Roman Haas. This is on TIPS database and customs data, you know, maintained. So yes, all these databases can be used. Before I move on to RPM and CPM, Vivek ji, any other questions?
One question is there from CA Nikhil Dhawan. What's your views on quasi-capital and comparability with loan?
Okay, so quasi-capital and comparability with loan, as far as CUP is concerned, I wouldn't compare quasi-capital with pure loan, because the FAR analysis of quasi-capital is that the intention was that it is not, the risk parameters are not purely of loan, you know, and therefore it should not be compared with a pure loan. You know, it's similar to the cases available on bank guarantee versus corporate guarantee. They are both guarantees, but a corporate guarantee in its nature and substance is different from a bank guarantee. And there, similarly, a quasi-capital in its nature and substance and the intention of giving a quasi-capital is completely different from a pure loan or a pure capital loan transaction. So personally, I wouldn't compare the two.
Okay. Okay.
Okay, so the next two methods that I'll do together are resale price method and cost plus method. So resale price method is based on gross profit, and cost plus method is also based on gross profit. Now, one of the things that I always like to say is that, or the way I remembered it, and somebody must have taught it to me a long time back, is that resale price method is like starting at the top of the stairs and walking down. And cost plus method is like starting at the bottom of the stairs and walking up. What does it mean? It means that under a resale price method, we start with the price at which the goods or services are sold to an unrelated party. We reduce from it normal gross profit margin that similar companies or similar entities would have earned, and we come to a purchase price, which is resale price method, and then that purchase price is judged with the purchase price of the actual transaction or the control transaction to determine whether it's at arm's length price. Cost plus method, on the other hand, starts at the bottom and it takes first the cost involved in rendering the service, and then you add on it normal gross profit margin, and you come to a arm's length price. This arm's length price is compared with the price at which you have sold the services or goods in the controlled scenario. So they both work on gross profit, but one starts from unrelated and comes to control price, and the other starts from unrelated cost and goes to control price. So they are both actually the reverse of each other. RPM is used where the seller does not do substantial value addition, and CPM is used where the seller does substantial value addition. So in a way, RPM and CPM are the antithesis of each other. RPM is used by trading entities, CPM is used by service entities. So the slides are there, and I'll quickly take you through the slides in the interest of time. We're nearing 5 o'clock. So this I've explained for RPM. Also, resale price method and CPM both have one thing in common, that usually there are no intangible assets in either scenario. So resale price is the most useful method for trading operations. It's easiest to determine when reseller does not add substantial value addition, and resale is more accurate when it's realized within a short time of the reseller's purchase of goods. So a reseller, a person who purchases goods, resells them without substantial value addition to an to a third party, is where RPM can be applied. RPM cannot be applied where the sale is to a related party. The first criteria of application of RPM is that the goods must be sold to an unrelated party. So there is a case law available of Kihin India, in which the purchase of traded goods was also from related party, and sale of traded goods was also to related party, and there was no value addition or no substantial value addition that was done by the trader. Now, assessee applied TNM and TPO applied RPM. The tribunal held that where the resale price is to a related party or is to an associate enterprise, at the threshold itself, as per Rule 10b(1)(b), RPM in law cannot be applied, and therefore RPM was rejected. So in applying RPM, the first thing to be seen is who is the buyer. If the buyer is an unrelated party, RPM can be applied. You reduce from it normal gross profit margin, less any expenses that are directly incurred in connection with the purchase or obtaining services, any adjustments for difference in par or difference in contractual ability or accounting practices or anything that is affecting the gross margin in the open market, and you arrive at the arm's length price. and you compare this price with the actual control price to determine whether it's at arm's length or not. Practical issues in application of RPM. So gross margins can be affected by minor functional differences. So both RPM and CPM require you to be very sure of what is the FAR of the comparables and how is that FAR applicable or comparable to the FAR of the tested party. Because any small difference in the functions can affect the gross profit margin, because as you know, gross profit is hardly 4 line items. So in any case, if there is a function that affects any of those 4 line items, it is a difference, and therefore you cannot apply RPM. So lots of times you don't have gross profit data. There it becomes difficult to apply RPM. Adjustments are difficult because there can be subjective reasons, like I've said, operational efficiency, economies of scale, etc. These things are difficult to adjust, and therefore, sometimes RPM is difficult to apply. What are the adjustments to RPM? So inventory levels, contractual terms, level of market, trader versus retailer makes a big difference for RPM. Foreign currency risk will make a big difference, because any loss on foreign currency or any gain on foreign currency will be, not considered for gross profit calculation. Any sales and marketing activities will be below the gross profit line, and therefore, the increase in the sale value will be available, but the cost won't be available. So the GP of a person who does sales and marketing will be higher of a GP of a person who does not do sales and marketing. So this will require an adjustment. Then use of tangible or intangible assets. So somebody who is using an intangible asset as a trader, or has a brand who is using that brand as a trader, will have a higher margin. So somebody who's a Panasonic or a Samsung dealer, a pure trader, will have a higher margin than somebody who is not, and who is dealing with all kinds of products, non-branded. So these are the kind of adjustments to RPM. Now a practical example on RPM. Now you'll see here that there's a purchase price from an AE at $80 and purchase price from an unrelated party at $82. There's freight inward, sales price, opening stock and closing stock. First step, you have to find what is the price charged by AE1 from UR1, right? Which is 106. Now you have to calculate the normal gross profit on sale of goods from unrelated party. So sales price 108, less cost of goods sold 60, normal gross profit 48. So 44% is the margin that the entity has earned from third party. Now the sale price to the AE was 106, to the third party was 106. Normal gross profit margin reduction of 44.44% is 47. So the sales price less normal gross profit, which is the COGS or the cost of goods sold, becomes 58.89. Now this 58.89 must be reduced by expenses, which is freight inward. You will adjust for opening closing stock. So now you come to a cost of purchase. So the cost of purchase in an arm's length scenario is 97.89. In my example, the actual purchase price was $80. Since you have purchased at a price lower than the arm's length price, the actual price or the control transaction is at arm's length and nothing needs to be done. These are some rulings on RPM, which you can go through in your time. Now cost plus. Again, in cost plus, I had explained that in the case where cost is incurred by the supplier of a property or a renderer of service, the cost is uncontrolled. You add to it the normal gross profit and you come to the controlled sale price. This is usually used in these 4 cases, where you have contract manufacturing, long-term buying and selling contracts, semi-finished goods, or where you're doing provision of services. This just says what the rule says. You start with the cost, you add the direct amount, the amount of normal gross profit, the normal gross profit that you added. If you have any functional differences, you adjust for it. The adjusted gross profit then increases the cost, and the sum so arrived becomes the arm's length price. So like you saw in RPM, the purchase price has to be compared. Here the sale price has to be compared. OECD also says that it can usually be used for semi-finished goods, or where you have similar market conditions, you have similar supply of property, and the resultant outcome will be ALP. Now CPM also is difficult to apply in reality, because there's the manufacturing or the assembly process to which CPM can be applied is a complex process, and to find another comparable that does exactly the same process as the tested party is difficult. If there is anything which is different in the process, or there is any level of engineering, etc., which is added, it makes it more difficult. If there are more activities that are added, like procurement, inventory control, testing, all these activities will determine what is the FAR and how complex is the tested party, and whether such a complex tested party can be compared with another complex comparable, or do we know if the comparable even does these transactions or not. So contractual terms and foreign currency risks are easier adjustments to do. The rest of the adjustments become very subjective and qualitative, and may not be, be able to be easily done. So CPM is also in practicality difficult to apply. So RPM and CPM don't need as strict a comparability criteria as CUP, but still, since they are only at gross profit level, they still require a more FAR-based comparability criteria as compared to maybe T&M. So I have here a CPM example also. This is a simple one where, a subsidiary earns a gross profit margin of 15%, and there's another related company that earns a gross profit margin of 10%. Here, obviously, because the gross profit margin is higher for, the subsidiary A, it's at arm's length. This is a more real example in which there is an unrelated party and a related party, or a associate enterprise. I've given you revenue from both, $120,000 and $110,000. Given you a breakup of employee, electricity, and supervisor costs. Now, employee, electricity, and supervisor are only direct costs. So CPM requires only direct and indirect cost of rendering of service. Now you can ask me that how is electricity a indirect cost of rendering or a direct cost of rendering the service? So let's say that without electricity, this software consultancy could not have been given, because how will you work a computer? How will you work your servers without electricity? So electricity becomes a indirect cost of rendering of service, something without which the service cannot be done. In one of my sessions, somebody asked me, then what about depreciation on the laptop or depreciation on the computer? Yes, you can add depreciation on the laptop or on the computer to this cost index, because it also becomes an indirect cost of rendering of service. But let's say rent, you can say that, oh, but we are sitting in an office and the office has rent, and that's also indirect cost of rendering of service. To my mind, no, because you could be sitting in a Taj hotel suite and giving these services from your laptop. Will you then add the rent of the Taj hotel suite? You won't, because you can as easily sit in a shared office space costing almost nothing and still give the same service from your laptop. So rent is not a cost of rendering of service, but depreciation on your machinery or your laptop and computers will become a cost of rendering of service. So in this case, total direct and indirect cost of rendering of service will become $100,000. Employee cost is direct, and electricity and supervisor's cost is indirect. Now we have to determine what is a gross profit ratio. In this case, we've taken all the costs of the indirect of the unrelated party and come to a gross profit ratio of 15.79. Now this gross profit ratio must be added to the actual cost. So my actual cost of rendering the service was $100,000. I add to it 15.79. My actual cost of rendering of service, or my sales price or arm's length price, becomes 1,15,790. I have actually rendered the service, or the value of the controlled transaction is 1,20,000. And therefore, since I have charged a fees higher than the arm's length price, therefore I am at arm's length and nothing needs to be done. Again, I've given some rulings on CPM, which are good rulings, which you can read. Now TNM. TNM, or the transaction net margin method, is the most used method because it is most tolerable to functional differences. Oh, sorry. Vivekji, any questions between RPM and CPM?
Query is there.
Hanji, bataiye.
This is from CA Sansaar.
Ji.
India company has its A in Singapore, having negative net worth. India company has subscribed its fresh issued shares, and in the balance sheet, same in impaired on fair value basis. Now question 1 is, subscription of share AE comes in the ambit of international transaction? If yes, what reporting and adjustment to be made in COI and in Form 3CEB?
Ji, so issuance of shares, from what I've understood, the Indian entity is subscribing to the shares of the subsidiary in Singapore. Or is it vice versa?
Nothing mentioned.
Okay. So let's say that I think from what I've understood is that the Indian company has a subsidiary in Singapore. It subscribes to the share.
AE in Singapore.
Hanji, so AE in Singapore, and it which is negative net worth. So it puts more capital into the Singapore entity, and it subscribes to the shares of the Singapore entity.
Yes.
So whether the Indian AE will have to report this transaction as investment in subsidiary?
Yes.
Answer is yes. They will have to report it as investment in subsidiary. Because it has a bearing. If you remember, there was a sub-clause in the definition of international transaction which says, or any other transaction having a bearing on the profits, losses, incomes, or assets of either enterprise. So here, this transaction has a bearing on the assets of the Indian entity, since this will be an investment in its books. So reporting has to be done, firstly in the 3CEB. Then the second limb of the question arises that subsequently what happens is that there is a impairment. And because of the impairment of the fair value, there is an impact on the computation of taxable income. Right?
Yes, yes.
So to my mind, I think the first transaction to be judged from transfer pricing perspective is that whether the investment in the Singapore entity was done at arm's length or not. That means that if it was done, obviously it can be done at zero. If it's negative net worth, there has to be a valuation report based on which it would have been done. Like in India, even if an entity has negative net worth, you cannot invest at lower than fair value and face value. So same way, there must be some valuation report which will say that the price at which the investment was done was at fair value or arm's length price. So I think that valuation report is what is to be used to determine arm's length price. The second part of the question on impairment, I think, is a normal computational issue for computation of taxable income, and the treatment that is, allowed by the relevant provisions of the Income Tax Act will have to be followed. But from a arm's length perspective, I think the valuation report will be the relevant document to prove that it was invested at arm's length price.
Okay.
Ji, anything else?
One query from Shivangi Mittal, but she has just mentioned enterprises and question mark.
Okay, Shivangi, please write back again. We are not sure what you mean by enterprises.
Yes. So you carry on, no issue.
G. So transaction net margin method. Transaction net margin method is a method that is most widely used. Some people used to say, oh, it's a residuary method. The government has said that no, it's not a, or OECD has said it's not a residuary method. It is also a profit-based method, which can be applied in a most reliable manner. It is most tolerant to functional differences and to product differences, and therefore it is also the most widely applied. This judges the net margin or the net operating profit earned from a controlled transaction vis-a-vis a uncontrolled transaction or a independent or earned by independent comparable companies. So here I have, what does the rule say, 10b(1)(e). Basically it says that you have to determine the net operating margin of the controlled entity, and then you have to determine the net operating margin of the uncontrolled entity based on a profit level indicator, and then come to what is the difference between the two operating profits. And if the operating profit of the controlled transaction is greater than the operating profit of the uncontrolled transaction, then they are at arm's length. Now, T&M also allows you to aggregate various transactions. So while a transaction by transaction analysis must be done, and I showed you initially in the definition of transaction in 92F, what does transaction mean? The law requires a transaction by transaction analysis, or even an aggregation of transactions can be done when they are closely linked. So what is closely linked? Closely linked is a transaction that requires another transaction or is so closely linked to another transaction that they cannot function in isolation. Like for example, let's say I'm a manufacturing entity. I source some critical raw material from one AE. I get technology from another AE. And that raw material and technology then I use in India, and I localize my production in India and sell my goods to Indian customers in India. Now, either I can benchmark the purchase of raw material and critical components and the payment of royalty as two separate transactions under two separate methods, or I can aggregate them together and say that without these two transactions are very closely linked to my entire manufacturing process, and I cannot judge their arm's length price in isolation, and therefore I must aggregate them. And I am going to judge it based on an overall profitability criteria of my entity as a whole. So I'll determine what is the net operating profit of my entity or of the controlled entity. And then I will see, okay, since these two form part of my cost base, my profit level indicator should be what? Operating profit by sales, because I'm trying to judge whether my cost is at arm's length price. If in a reverse scenario, let's say that I had all my costs in India and I was an exporter and I exported 80% of my sales to a AE. Over there, when I was to judge whether my operating profit is at arm's length, I would take my operating profit divided by cost, because I have to determine that whether my sales is at arm's length. So it would have to be divided by cost. These ratios of operating profit by cost or operating profit by sales are called profit level indicators, or in transfer pricing terms, PLIs. And these PLIs help you judge whether you are at arm's length or not. Again, adjustments are allowed in T&M. Again, reasonably accurate adjustments can be done to determine whether comparability materially affects the price in the open market or not. Any adjustment that is reasonable and accurate is allowable. So here I have reproduced the law. So the steps required for T&M. First is obviously the performance of functional analysis. That is the first criteria of judging what your controlled entity does. Are you a manufacturer? Are you a trader? Are you a service provider? Whose profit margin are you judging? What is the comparability that you're judging? The second step is to identify who is the tested party. Is it the excuse me, sorry. Is it the tested party? Is it the Indian entity, or is it the foreign entity, a foreign AE? Who is the more complex party? which is the least complex party, for which party can you get reasonably reliable data, for which party can you make reasonably accurate assumptions. The third step is to identify the comparables. The next step is to choose the profit measure. Like I've discussed, profit measure is the PLI. Is it going to be operating cost by OP by sales or OP by cost? What is it that you're going to compare? Then you need to determine the time period for the analysis. Do you have enough data to compare it for the single year? Are you going to use 2 years prior data, which now Rule 10 CA allows you to use? And then you have to test the reasonability of the result. So there are 3 types of PLIs that are allowed. Return on net sales, which I've explained, OP by net sales, OP by operating cost. Now the third type of PLI that is allowed is OP by or operating margin by assets employed. Now this is typically used for contract manufacturers where they've invested a large amount in the infrastructure, but may not be making a large margin on sales or on cost, but they want to be some assured on the investment made by them. So OP by assets employed is also a acceptable PLI. What does OECD say? OECD says that under T&M, functional analysis is required, and then you have to determine what are the comparables and if adjustments are necessary and if they lead to reliable results. And under T&M, parties must not contribute unique intangibles, because for unique intangibles, there is a sixth method, or the PSM, or a profit split method. So under T&M, no unique intangibles must be contributed by either of the AE or the tested party. So practical issues for T&M. It can apply to any type of transaction. It can be a supplemental analysis. You can have a most appropriate method of CUP. You can still do a secondary analysis under T&M. T&M is more tolerant to functional differences. It may be less affected by accounting differences because it takes into account the whole P&L. Practical solution to otherwise insolvable and complex transfer pricing problems. So where you can apply nothing, you can try and apply T&M. So practical example on T&M. This is again a very simple example like I used in CPM. 10% net margin in same business of an unrelated entity and 12% in a related entity. And so 12% being higher than 10% is at arm's length. But in practice, you don't actually apply it like this. You apply it like in this other example that I've given, where enterprise has a total sales of 7 lakhs. It has sold 1 lakh worth goods to associate enterprise and 6 lakhs worth to others. The cost of goods sold is 3 lakhs 50, 25,000 worth to associate enterprise and 3 lakhs 25 to others. It has other costs of selling, admin, gain on sale of fixed assets, depreciation, interest. So 2 lakh 55 worth of other expenses. Total cost is 6 lakhs 5,000 and net profit is 95. Now this 95,000 net profit is the net operating profit of the tested party. Now how do we take out the PLI? Now the net operating profit plus interest cost minus gain becomes the net operating profit. So there's a difference in T&M between operating profit and net profit and net operating profit. In operating profit determination, we have to take only those things which are linked to operations. So when we did AS3 and we learned what is investment activity, what is operating activities, what are financing activities, that same criteria should apply here. So if you know interest is a financing activity. Same way, gain on sale of fixed assets is not an operating activity, right, under the Income Tax Act. So this will also go out of this computation. So the operating profit of profit from operations will be only 75,000. Now total operating cost is COGS plus selling and distribution expenses plus depreciation. So 3 lakhs 50 plus 2 lakhs 15 plus 10,000 is 575. So my net operating profit divided by total operating cost will become 13.04%. This ratio I have explained is the profit level indicator. Now we have to find what are functionally comparable companies. Let's say we used the ProWaste database or we used the HTP database and we came up with functionally comparable companies whose same way we calculated the net operating margins to total operating cost. And let's say that margin was 12%. Now we have to see if there is any adjustment required. In my example, I've said, okay, no adjustments are required. Now, how do I determine arm's length price? Now, if you remember, my total operating cost was 5,75,000. The PLI of comparables is 12,000. So my net operating profit becomes 69,000. Based on 69,000, my sale should have been 6,44,000. My actual sales is 7 lakhs. The difference between my actual sales and the ALP sales is 56,000. My actual control transaction, which was sale to AE, was 1 lakh. Now the difference of 56,000 proportionately allocable to 1 lakh is 8,000. So my ALP of control transaction becomes 92,000, whereas my actual sale price was 1 lakh. And since my actual sale price was greater than the ALP sales price, I am at arm's length and nothing further needs to be done. So things that are factors which may affect the T&M. Difference in working capital, this may affect my T&M because it's operating cost. Difference in import versus domestic content. I have more reliance on imports. I may have to pay higher custom duty, etc. Difference in capacity utilization. Because of a lower capacity utilization, I may have a higher overhead cost which is unabsorbed and therefore lower profit margin. Difference in business models. I may be doing advertising versus somebody who's not doing advertising. I may be doing sales promotion versus somebody who doesn't. I may be giving discounts versus somebody who doesn't. I may have a difference in functions. I may be a limited risk distributor versus a full-fledged distributor. So these things will all cause a difference in the net margin, which either have to be adjusted, and if I can't adjust them, then I have to reject that comparable. So again, here I've given some rulings on T&M. T&M rulings are very easy to get. Any database that you subscribe to, you'll get many T&M rulings. So any questions on T&M before I move to profit split?
I think you can carry on. Many queries are there that we will discuss.
Okay, so profit split, I won't go into as much detail. Profit split basically usually is not applied because it's very difficult to apply a profit split method. It usually requires where two or more A's contribute unique intangibles to the same output. In such a scenario, like for example, I was, let's say, Microsoft US, and I created Microsoft version 2.0, and now the world needed 3.0, and I gave 2.0 to India, and I said, now from 2.0, please, upgrade this to 3.0. So Indian teams then worked on version 2.0 and created version 3.0. In such a scenario, who should get how much of the profit that will be earned on the ultimate sale of version 3.0? Now 3.0 could not have been created without 2.0, could not have been created without the contribution of the intangibles by the Indian team who took it from 2 to 3. So in such a case, PSM is applied where two AEs have contributed their unique intangibles to create an output and therefore create a final profit. PSM can be applied in two ways, either on contribution analysis or on residual contribution analysis or residual analysis. Contribution analysis is very difficult to apply because it says that what is the contribution if 2.0 would have been sold as that software, what is the contribution based on the FAR of Microsoft US, and what is the profit it should have earned. Same way, what is the profit based on the contribution of Indian entity, and what is the profit based on third-party comparables it would have earned. So this data to be available in public domain is very difficult. and therefore certain assumptions have to be made. And those assumptions are internal to every organization. And as in case of assumptions, which are usually very subjective, very difficult to look at the veracity of those adjustments, and therefore very difficult to apply PSM. In my slides, I've explained exactly this. For the transfer of unique intangibles, I have given the rule that's there in the rules. I have said that what OECD has to say about it, that profits should be split on an economically valid basis that reflect the functions and risks of each of the parties. Now, it's very difficult to say what is an economically valid basis. And then it says it's necessary to identify the total profit arising and split that profit between the parties according to the respective contribution. Again, how to determine the respective contribution is very, very difficult. So I've said over here that, I've explained this already. I have given an example. This is what the bird's eye view looks like. That the AE1 and AE2 have contributed to earn a combined profit to a third party customer. Both AE1 and AE2 have done some basic functions. Add to that their relative contribution, and then you have to determine the profit split. So again, contribution analysis and residual analysis. So I've given an example also. And if anybody wants these slides, I'm happy to share the example. It's there in the book as well. So basically, so here the combined profit of the associate enterprise, A1 had earned 36,000 and A2 had earned 10,000. So they had a combined profit of 46,000. Now I've assumed in this example that the relative contribution is 60-40. But again, this assumption is an assumption. And based on the total profit of 46,000 and based on relative contribution, A1 should have made a profit of 27,600 and A2 should have made a profit of 18,400, whereas A2 has made a profit of 10,000 and A1 has made a profit of 36,000. And therefore, there has to be a transference of profit from A1 to A2 to apply the PSM. So the total profit, if you'll see in the last row, is 46 only. But there has to be a change in the profit inter se between A1 and A2 through the revenue model so that the correct profit is allocated to the correct entity based on its contribution. I've explained how this is to be applied. This is the residual analysis, that once the basic profit is already allocated, then what is the residual profit that can be allocated? So the residual profit of 46,000, out of that 8,400 and 2,250 we have already allocated. In the first stage, based on the basic return on personnel cost of 35% and 15%, which is based on the FAR done for their contribution based on their comparables. And now 35,350 has to be allocated based on relative contribution, which now becomes 60-40 again in this example. And therefore, again, if you see in the last row, the profit will remain 46, but the transference from A1 to A2 will change. So like in the first example of contribution analysis, profit of A1 was 27,600. Here it's become 29,600. And A2's profit, that was a different figure, has also become 16,390. So there's a slight difference between residual analysis and contribution analysis. Very few rulings available on PSM. I've given 3 here. So yes, I am now giving a quick recap on TP methods. So CUP requires very high comparability. It benchmarks prices. Practical applicability is low because availability of reliable data is low. RPM, CPM comparability is high but lower than CUP. Gross margins are benchmarked. Practical applicability of RPM is low because it still requires more functional comparability. CPM is still higher. Practical applicability is medium because in India you can get a lot of data with regard to services companies. PSM, comparable requirability, is high. Operating margins are benchmarked with residual profit and contribution analysis. Practical applicability very low. TNM is medium comparability. Operating margins are benchmarked. Practical applicability is high. Other method requirements are high. Prices are compared and it is used for selected transactions only. So this is a quick recap.